$318.41. That is the number flashing on the screen right now. And if you are watching the intraday charts, you are seeing a massive green candle pushing Alphabet Inc. Class C, ticker symbol GOG, up by exactly 18.76 points, or a staggering 6.26% gain on the day so far. The market is officially open, the volume is pouring in, and we are witnessing what looks like a decisive breakout above the psychological $300 ceiling that has acted as a stubborn resistance level for weeks. If you looked at the pre-market data or the headlines from last night, you might have expected a muted session. Maybe a slight pullback as traders digested the recent antitrust closing arguments. The expectation was that regulatory clouds would keep a lid on this stock, trapping it in a holding pattern, while the rest of the tech sector rallied. That was the narrative. Google is the boring monopoly, entangled in lawsuits, slowly bleeding market share to nimbler AI competitors. But the reality playing out on the tape today is violently different. The reality is that the market has suddenly woken up to a catalyst that completely overrides the legal fears, and that is the disclosure that Berkshire Hathaway, Warren Buffett's fortress, has built a multi-billion-dollar position in Alphabet. When the Oracle of Omaha rotates from Apple stock, which he has been trimming, into Google, it sends a signal that no algorithm can ignore. The valuation floor is real, and the growth story is far from over. We are seeing a classic flight to quality, where institutional money is realizing that Google isn't just a search engine under siege. It is arguably the most undervalued AI infrastructure play in the entire market. While everyone was chasing the parabolic moves in Nvidia stock earlier this year, smart money was quietly accumulating GOG at a discount, and today's price action is the violent realization of that discrepancy. The stock opened at 310.79, dipped briefly to 305.32 as weak hands sold the news, and has since ripped higher to this 318 level, obliterating short positions that were betting on a DOJ-induced collapse. Let's talk about what is actually driving this momentum beyond just the headlines. When you look at the order flow today, it is not just retail traders on the Robinhood app chasing a hot ticker. This is sustained, high-volume accumulation. We are seeing block trades executing well above the volume-weighted average price, which indicates that funds are not waiting for a pullback. They are buying at market. This is the behavior of portfolio managers who are underweight and desperately need to catch up before the quarter ends. There is a palpable tension in the price action. Every time the stock tries to tick down a few cents, a wall of bid orders steps in to prop it up. It feels like the market has collectively decided that the breakup risk is priced in, and the AI monetization reality was vastly underestimated. The divergence here is fascinating. Usually, when you see a tech giant rally like this, it's because of a single product announcement or an earnings beat. But today's move is structural. It's a re-rating. For the last 18 months, the expectation was that ChatGPT and Microsoft would eat Google's lunch. The fear was that search is dead. The reality we are seeing today, bolstered by the release of the Gemini 3 model and the integration of these tools into the enterprise cloud stack, is that Google's moat is actually getting wider. The new agentic capabilities of Gemini 3 are not just a chatbot feature, they are being deployed into corporate workflows, effectively locking customers into the Google ecosystem deeper than before. This is what the market missed. They thought AI was a disruption to Google. It turns out AI is an accelerant for Google Cloud, which just posted that 35% revenue growth figure. If you are sitting there with your Schwab Intelligent portfolios or managing your own individual brokerage account, you might be wondering if you missed the boat. That is the wrong question. The right question is, has the market fully appreciated the sheer scale of cash flow this company generates, even while it pivots? Most online investing platforms will show you the PE ratio and the historical chart, but they won't tell you about the operating leverage kicking in right now. We are seeing a scenario where Google's capital expenditure on TPUs, tensor processing units, is finally translating into tangible revenue, not just research costs. While NVIDIA stock has been the shovel seller of the AI gold rush, Google has been the miner building their own shovels, and that vertical integration is saving them billions in margins that are now showing up on the bottom line. I want you to take a second and look at the sector comparison. Look at Tesla stock today. It's moving on macro news, interest rate hopes. Look at Apple stock. It's trading on hardware cycles. But Google? Google is trading on a fundamental repricing of its future cash flows. The narrative has shifted from DOJ victim to AI value play. It's a rare setup. Usually, you have to choose between deep value and high growth. Right now, GOG is offering both, and that is why you are seeing this relentless bid on the intraday chart. The relative strength index on the 4-hour chart is getting heated, sure, but in a breakout scenario like this, overbought conditions can persist for days. We saw similar behavior in SoFi stocks during their fintech rally. Momentum begets momentum. Now, I want to pause and ask you something, because this is the elephant in the room that no one likes to discuss without arguing. Comment below with your take. Do you honestly believe the Department of Justice will succeed in forcing Google to sell off Chrome or Android? Or do you think this will end with a slap-on-the-wrist fine and some behavioral changes? I read through the closing arguments from the Remedy trial that ended on November 21st, and the government's case for a forced breakup relies on proving that these divestitures wouldn't destroy the ecosystem. Google's defense was essentially, you can't unscramble the egg without ruining the omelet. It's a high-stakes poker game. Let me know in the comments, are you betting on a breakup or a settled peace treaty? Getting back to the analysis, we have to look at the broader context of how retail and institutional investors are positioning. If you look at data from Fidelity Investments, specifically the inflows into Fidelity mutual funds and Fidelity ETFs that hold heavy tech weightings, there has been a rotation back into communication services. For a while, money was hiding in healthcare and utilities, defensive sectors. Now, the risk-on trade is back. But it's selective. It's not a blind buy-everything market. Investors using the Fidelity mobile app or the Fidelity trading platform are getting more sophisticated. They are looking for companies with balance sheets that can weather a higher-than-longer interest rate environment if the Fed pauses cuts. Alphabet has over $100 billion in cash. That is not just a safety net. That is a war chest. It allows them to buy growth, settle lawsuits, or buy back shares aggressively, which they have been doing. Let's shift gears and talk about the company itself for those who might just know it as the search bar on their phone. It's easy to forget the sheer breadth of this conglomerate. You have Google services, which include Search, Android, Maps, Google Play, and YouTube. YouTube alone generated over $50 billion in ad and subscription revenue over the last 4 quarters. Think about that. YouTube is effectively a Fortune 50 company sitting inside Alphabet. Then you have Google Cloud, which is the engine driving this new leg of growth. Unlike the ad business, which is sensitive to economic cycles, the cloud business is sticky. Once a corporation moves its data to Google Cloud, they rarely leave. And then you have the other bets, Waymo, Verily, and the moonshots. For years, these were money pits. But Waymo is now scaling its autonomous ride-hailing service in multiple cities, generating real revenue. The market used to value other bets at 0 or negative. Now, with Tesla facing hurdles in its robot taxi rollout, analysts are starting to assign a non-zero value to Waymo. That is a hidden kicker in the stock price that you won't find on a standard Robinhood cash management summary. Speaking of platforms, if you use Interactive Brokers stock trading or their professional Interactive Brokers platform, you might have noticed the options activity on GOG. The implied volatility has crushed lower since the earnings and the trial conclusion. This IV crush usually happens when uncertainty leaves the market. The fear premium is evaporating. Traders are no longer paying up for put protection. They are buying call spreads. This is bullish. It suggests that the sophisticated derivatives market expects the stock to grind higher, not crash. It stands in contrast to the sentiment we see on forums discussing SoFi investing or Robinhood crypto plays. Here, the flow is steady, institutional accumulation. However, we must ground this in the risks because blind optimism is the fastest way to lose capital. The expectation is that the DOJ trial is old news. The reality is, the judge's decision, expected mid-2026, could still be a shocker. If the court orders a structural separation of the ad tech stack, as the DOJ demanded in the